Guys, understanding this cycle is going to revolutionize your trading no matter what asset that you trade. But I'm going to be showing you in this video exactly these two cycles: expansion, contraction, the trait of each, what to look for, and what assets perform well in each environment. And regardless of whether you just trade one asset or you just trade another, you should get some value from this. Okay, so let's not waste any more time. Two main phases. Now, this might surprise you. We have expansion and we have contraction. We have periods of growth and we have periods of contraction, or some would say recession at the lower end of this curve right here. Now, we've got to understand how the money flows. Before we even get into any of this, we need to first understand that there are two things. Well, there's one thing really that investors are looking at, which is risk. If you are somebody who is looking to put your money anywhere, are you more likely to put your money into something that is more likely to be risky or more likely to be safe? For most people, it is going to be looking at something that is more safe. And so whenever you ask yourself, what asset is likely to be performing well right now, reframe that question. So let me write this out for you. So don't ask what asset is likely to perform best now. Ask what assets are currently slash about to be more risky and less risky. Why is this a better question? Because if you can understand this, then all it really comes down to is, are you good enough at assessing whether something is going to be a risk environment or a risk off environment? This is the whole risk on, risk off type thinking. Now, how does this relate to everything that we're talking about? Well, like I said, there are two main phases. We have expansion, contraction, and then we have these kind of little micro phases in the middle. Now, in order to understand what is going to be risky and what is not, we need to understand a couple of things. First thing, central banks. The central banks are critically important for everything that goes on, because understanding interest rates and understanding how the central bank functions is arguably one of the most important things that you can understand fundamentally. Because the only reason that the market itself curves and that it doesn't just go up in a straight line like this is because of debt. It is because of debt. And the central bank's input of interest rate and purchasing, and I'll explain what they are in a second. Those are the tools, or some of the tools, that are used to manage where we are at on that debt cycle, to make sure that the economy doesn't overheat or completely crumble and fall to nothing. So over here, central banks, interest rates and purchasing. These are the main two things that they're going to be using in the short to medium term. There are other things. They will have economic projections, stuff like this. But these are going to be the main two things. Now, why are these important? Well, because these two things are going to, well, how they use these two things are going to behave differently at different stages of the cycle. So just by understanding, okay, what phase of these are we going into, is going to give you a huge insight, way more than any person just on a technical price chart is ever going to be able to give you. So how do we break that down? What does it mean? So let's go through each stage, because it's going to make more sense. During an expansion phase, what is the goal of the central bank? Well, the goal is to manage that growth, because it's possible for economies to overheat, to overgrow, to over borrow, and that can cause major crashes. And to manage inflation, because when things are going well, it's very easy to overspend, to borrow more than you should. And so over time, all of these things can lead to inflation. It's very, very easy to do. There's lots and lots of things that go into it. But just as a simple summary, the goal during this phase is to manage growth and inflation. We've seen this, by the way, in recent times, because what's been happening the last couple of years? We have been raising interest rates. We've been tapering. So tapering is the opposite of, if you've ever heard, the kind of fear mongering videos online or in the news going, we're heading into a recession. All the central bank is printing money again. Printing money is quantitative easing, right? Tapering is the opposite of that. It's basically reducing their holdings in certain assets, normally going to be government bonds. Now, even if you don't know what that means, just know that these two things here are two ways of doing a very, very similar thing. Their goal is to manage growth and inflation, and doing these things are two tools that they use to do that. Regardless if you know all of the intricacies of what they mean and how they all work together, it doesn't actually matter so much. The most important thing is that you understand that these two things are what happen typically during an expansion phase. Now, it doesn't necessarily mean that the economy is in a massive growth cycle. It just means that if inflation or growth is overheating in any way, then the central banks will step in by doing these two things, or one of these two things, normally a little bit of both. And so then at a certain point, we're going to enter a contraction phase. Now, during this phase, the signals are going to be lowering interest rates and quantitative easing, or QE. This is, again, as I said, basically printing money, where they buy up normally government bonds, treasuries in the US and stuff like this. Because the goal during a contraction phase is to stimulate the economy, because things are shrinking. We're starting to see the downsides of all the things that we were doing during the expansion phases, raising interest rates. This is great in the short term because money flows towards that currency. But over a long period of time, raised interest rates actually cause damage, because there's less borrowing, it's more expensive to borrow, it's harder to borrow, there's less spending, people are saving more, they're not spending as much in the economy. And so over time, what happens is that contraction begins to happen, and then the goal changes. It's to stimulate the economy again. Now, the reason that this is such a critical point in time right now is because if we look at how the central bank has and how the interest rates have been behaving in the last couple of years. And by the way, this is the government bond 2-year yield. So this correlates very, very, very directly with the interest rates in the US. And we can see for the last few years, right, we've seen a steep increase in the US interest rates, right, approaching all the way up to, what's the top, about 5.25%. Now, we had this steep incline, and then ever since a certain point around about here, we've just started kind of consolidating. Why is that important? Because it was around about here where the Federal Reserve, which is the US central bank, stopped increasing their rates. They stopped indicating that they were going to continue aggressively increasing their rates. And so the market started consolidating naturally, because there was no new information saying that they were going to go up, and there was no new information saying they were going to go down. They were just kind of holding. Now, this was because they were looking to manage inflation, because remember, what were they looking to do? They were looking to, by raising rates, they were looking to manage inflation. Because they were managing inflation, at a certain point, by looking at the economic data, going, okay, well, how have the inflation metrics been trending? We can begin to make some predictions about, okay, well, maybe the central bank might be beginning to cool down. Maybe they'll begin to lower interest rates again, which would be the first indication that we would be heading into this lower phase, to this lowering of the rates contraction type phase. Now, this is where forward guidance plays a key role, because you don't even need to forecast at all, really, because the central banks most of the time will just tell you straight up what they want to do. Now, this is typically going to be interest rate expectations and purchasing expectations. You'll find these all the time. So if you look at, with the Federal Reserve in the US, FOMC minutes, their statements, all the things they release, which will be on their websites, you can just look at this, and you can even just put the little summary that they'll give you, put it into ChatGPT, ask it to be put into simple language, and ChatGPT will explain it to you. You don't actually even need to understand it much anymore. And basically, this forward guidance, they'll tell you what they want to do, or what they're planning to do for the next few months, normally, sometimes even for the next 6 months. And whilst that may change slightly, sometimes, most of the time, it won't. Why is this so important? Well, because right now, the Fed, for the last time a couple of weeks ago, suggested that they may be beginning to look at reducing the interest rate. Why is this important? Because we have gone from increasing rates and tapering to then lowering rates, potentially in the future, which means we could be beginning to shift phases. So, what does this mean for what could be more risky, what could be less risky? Well, let's go through and think about this. Back to our question here, what assets are likely to be less risky? Because remember, money is going to flow towards less risky assets during particular periods of time, during a period where interest rates are being lowered. Well, in order to answer that, let's answer it in a bit of a backwards way. What assets performed really, really well during the period of raising interest rates? Well, commodities, gold, performed very, very, not gold, Gold performed well. Why? Because a commodity, especially gold, that's pinned against the dollar, as inflation fears are coming into play, and inflation, each one of your dollars is worth less. Therefore, people look to put their money into something that is seen as more stable, seen as more risk averse. Gold is one of those things because it has always been a store of wealth. This is why gold grew in value, right? Now, on the flip side of this, what is hurt during this phase? Well, typically, what's hurt during this phase, especially with raising interest rates, is going to be stocks. Now, we actually haven't seen that in this case, and this is where things can get a little bit intricate because the stock market has been rising, which makes everything really, really confusing because we look at this and we're like, Jesus Christ, we've seen this huge boost. Now, this is for a multitude of reasons. One of the reasons is the fact of all of the money printing, increasing the liquidity in the market. There's lots of different things. The point is that what when we are assessing what the good environment is, we can only really look at what the principles are. Most of the time, during high inflation periods like this, where interest rates are rising, you will see gold typically and other commodities often tending to rise as well. However, during the other environments, what other sorts of things are going to happen? Well, the bond market, which I just showed you over there with the yield, that is going to decline. I predicted that is why I had an arrow right here. I believe that we're going to decline at least to about 2.5%. This is not a number I pulled out of thin air. This is based on a lot of analysis to get to this point. And so this would be one example of an asset that I think is going to perform well in terms of the people who are shorting it there. The next common relationship is going to be with the stock market. Typically, you're going to see, especially with certain sectors, so for example, real estate, as interest rates are lowered, because if you think about it, real estate especially, has a lot of borrowing, mortgages, all these sorts of things. And so higher mortgage costs, i.e. interest rates and stuff like this, that's going to massively affect those companies. And so those companies are going to normally start to do well over the next maybe 6 to 18 months, uh, rather than other sectors that maybe aren't so affected by it. Tech stocks typically will have a similar sort of effect as well. They're going to do well during these contraction phases most of the time, not always, but most of the time. And so understanding these are going to be really, really critical. FX, of course, this is going to be affected as well. The only difference with FX is that realistically, it's more so about just comparing this cycle between two different currencies, because realistically, you're looking then at multiple factors. And with FX, there are so many things that are influencing price that sometimes fundamentals, when you're trying to forecast direction, can be really, really misleading. But that doesn't mean that this isn't useful for FX. What it actually means, it just means that we need to switch from looking and forecasting direction to forecasting volatility. In other words, going, look, are we entering a period of consolidation, or are we about to enter a period of trend? Whether that trend is up or whether it's down doesn't matter. Just being able to forecast that allows us to build a risk structure around that works. This is one of the things that we like to do. It's the key thing that we like to do with FX, and we're also working on a trend system as well. But that is unlikely to be in the FX markets, because it's not typically a trending environment. But anyway, guys, I know this has been kind of a lot of information. Some of it may be new to you, some of it may not be new to you. But really, the key thing is to always ask the question, what assets are currently about to be more risky and what assets are currently about to be less risky? Because money will flow towards the less risky. This is another reason why all of the different things, for example, Euro USD right now, just not looking at Euro at all, USD expectations have been getting weaker of recent, which has been a big reason for this boost in Euro USD. Yes, the FX markets are slightly less predictable in terms of direction, but if you traded a different market or if you just used it to forecast volatility, there are so many options out there, and it really just depends on the type of trader that you are, how long your time horizon is, and all these sorts of things. And really, this is the tip of the iceberg, guys. Honestly, this is just a very, very beginner level understanding. If you'd like to learn more about these things, then please do let me know. If not, you're more than welcome to join the Discord. Link for that is in the description. But if not, there's lots of tools and resources on this channel, and I'm sure many other channels as well, that you should go and check out. So I hope you have an amazing rest of your day, and I'll see you in the next one. Take care, guys.